A hidden shift is unfolding in the backbone of U.S. finance. FedNow 2.0 isn't just faster payments. There's a question. Are you about to gain liberation or lose control? We all know the Fed introduced FedNow in July 2023 to let banks move money in seconds around the clock any day of the year. Over 1,000 institutions are now live building apps that push and pull funds instantly. That's innovation. But underneath, there are layers few see. Let's unpack the benefits first. Instant cash flow empowers families living paycheck to paycheck. Imagine your paycheck depositing and clearing instantly. No waiting, no late fees. Households gain peace and merchants get timely revenue. Small businesses gain agility. Invoice paid? Funds clear immediately so you can reinvest instantly. No costly credit lines. No cash flow lag. But bigger than individuals or small firms, FedNow 2.0 could reshape the payments landscape itself. It's cheaper per transaction than debit cards. Banks reportedly pay less than 23 cents per swipe. Visa and MasterCard are watching. Major banks like JP Morgan Chase and Wells Fargo are on board. Over 800 firms have signed up according to Barron's. This network effect means almost every bank could end up connected. That brings innovation. The Fed gives banks a platform, cloud-based, secure, always on, to build new payment tools and services. From payroll to peer-to-peer apps, FedNow is the foundational rail. So yes, the promise is real. Faster, cheaper, more efficient money. That's the liberation pitch. But then there's the deeper question. What if FedNow becomes a tool for more control? Real-time data on every transaction every second of the year. No batching, no delays, every move visible instantly. That's unprecedented visibility. And who operates the rail? The federal quasi-government. Not a fintech spendy startup. This is central oversight. They say FedNow isn't a digital currency. It's not digital dollar, true. But the infrastructure it provides is similar. Instant, traceable digital money flowing through regulated nodes. Future FedNow 2.0 updates could layer in features, program transaction limits, flag trades, automate compliance checks in real time. And who triggers those? Not users. Imagine having a payment froze before your eyes because an algorithm flagged it. No due process, no human review, instant denial. That's not liberation. And yes, fraud detection will improve. Real-time monitoring is the top priority for compliance pros today. But fraud fighting can easily morph into surveillance. Now here's the midpoint twist. While we're busy admiring speed, behind the scenes, banks are debating whether FedNow will displace Zelle, PayPal, or even Visa debit rails. But that's only half the story. Private networks like the clearinghouse's RTP still process double the volume and allow pull payments and higher limits. FedNow may be cheaper, but it's initially limited to push only with lower caps, so full adoption remains distant. Which begs the question, if FedNow isn't the most robust rail yet, why push it now? Why build a government-owned system parallel to private ones? This is where the narrative turns. Consider global trends. India's UPI, Brazil's PIX, their digital public infrastructure. The UN even cites them as models of interoperable platforms for financial inclusion. Governments want control layered in. The Fed is quietly stepping into that space here, too. With a public rail, the government holds the baseline infrastructure. Private players can build on top. That makes oversight easier. Less obvious is the surveillance potential. Real-time visibility into income flows, spending habits, financial behavior, data that's gold for regulators, policymakers, even future governments. That brings us to the stat hook. Flagged subtly but powerfully. In 2022, U.S. debit card transactions amount to over $70 billion in volume. If even half shifted to Fed, now the Fed would have instant visibility into trillions of dollars in personal spending. That level of oversight hasn't existed before. Now feel the tension build. FedNow 2.0 launches, armed with public mandate to modernize payments. It's efficient, cost-effective, rapid. But efficiency without constraint is vulnerability. And here's where it splits. If governed by transparency with strong privacy safeguards, it becomes a tool of liberation, empowering individuals and businesses. If governed by control, it becomes a panopticon rail. Every payment visible, stoppable, modifiable. We face a crossroads. The Fed claims no desire for digital currency or to replace cash. Yet they built a system that could evolve into one, incrementally, silently. And here's the final emotional spike. What will you do when your paycheck clears instantly and real power over it lives elsewhere? When your app flags a payment absent appeal rule? When speed becomes surveillance? FedNow 2.0 is not just a payments upgrade. It's a test of trust between you and your government's financial infrastructure. Will you demand transparency, privacy rights, institutional checks, or will you let efficiency become control? You're already in the middle of this silent transformation. Decide now how you want it to end, but here's what's quietly being built on top of these rails and why it matters far more than most realize. Imagine a future where your tax refunds, stimulus checks, unemployment benefits, and even Social Security are routed directly to you in real time through FedNow. No mailing delays, no bank intermediaries. The Fed could become the go-between for most government-to-citizen money transfers. On paper, this sounds incredibly efficient, a safety net that works at the speed of life. But it also centralizes power in a way we've never seen before. In a crisis scenario, say a financial panic or mass bank failures, FedNow could be rebranded overnight as a stability layer. In such a moment, the idea of instant digital wallets managed or guaranteed by the Fed wouldn't seem dystopian. It would seem necessary. This is how sweeping change often arrives, not through legislation, but through moments of fear, framed as solutions. If the public is gradually nudged into relying on FedNow for faster paychecks, direct stimulus, emergency aid, and private transactions, then opting out becomes less of a choice. Physical cash usage would fall. Alternative networks would fade. And when those fail to stay competitive, FedNow becomes the default path for every transaction, by design, not by force. Let's pause here and look at China for comparison. Their central bank launched the ECNY digital yuan pilot in recent years. It's programmable, it's traceable, and it allows for direct stimulus and spending controls. FedNow is not the ECNY, but the architecture we're seeing here is not that different. You may hear officials say FedNow isn't a CBDC, and that's true, but it's a precursor to one. A soft rollout, infrastructure first, currency control second. You don't need to flip a switch. You just need to wait until it becomes inevitable. And this is what institutions understand: the power of infrastructure. The banks connected to Fed now today aren't simply experimenting with faster payments. They're preparing for a new standard, one that once embedded can be evolved without permission. Now let's go deeper beneath payments. In this new model, trust doesn't come from your local credit union. It comes from the central authority that controls the network. The code becomes the arbiter of fairness, and when code makes mistakes, as all systems eventually do, your appeal options may be limited. Say your account is locked. Your transaction is denied. Your access is frozen due to a flagged behavior or unverified identity check. Who do you call? Where do you go? That's the hidden risk of centralized rails with decentralized customer service. The private sector may still offer the front-end apps, your digital wallet, your mobile dashboard, but the actual highway of money? That's government-operated. And with that comes federal priorities: taxes, compliance, risk monitoring, sanctions, behavioral modeling. In a world where money moves in milliseconds, control must too. That's how the logic will be framed. And if you think none of this applies to you, consider how quickly the narrative can shift. From innovation to national security. From convenience to control. From voluntary to mandatory. In 2020, when the U.S. debated stimulus during the COVID crisis, there were real legislative drafts proposing digital wallets held directly at the Federal Reserve. These proposals didn't pass, but the architecture was laid out. And now the rails to make that system a reality are already in place. That's how these changes happen. Not in a single vote, but in stages through tools that seem helpful at first, until they quietly become irreversible. FedNow 2.0 isn't just a payment upgrade. It's the launchpad for an entirely new financial structure. One that could either empower the public or permanently centralize monetary power. The question is no longer if the system will expand. It's who will control it when it does. And once that control is coded in, it won't be easy to take back. Subscribe now for more signals that matter.